What state are the stock markets in? Why have decade-long bull markets suddenly reversed and are going down? What can we do about it, and how should we behave in these difficult times from an investor's point of view? We are in the new year 2023, and for almost 40 months the stock markets have been falling to minus 25% of October 2022 levels. The best way to show this is in the broad S&P 500 index, where we see that December 2021 to today the markets are in bear captivity and still looking for a lower and lower low. Welcome to my channel Invest with Jiri. I'm so glad you are interested in the current situation in the stock market. Today we'll discuss the reasons for the market decline and how I think the Fed will behave in the coming months in terms of setting interest rates, which will be pivotal to jump-starting economic growth. If you are interested in investing in the capital markets and want to learn how to find stocks with appropriate intrinsic value, check out my Patreon, a link in the caption below the video. If this is your first time on my channel, join my community by clicking subscribe and bell so you don't miss my other videos on investing. Let's get to it. Are we in a recession yet? We should explain what a recession is, because based on that we can tell if we are already there or if we are about to be. Definition of recession is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in two successive quarters. And by that definition, the US entered a recession in the summer of 2022. On the S&P 500 chart, it's somewhere in this and at this point. Why did the markets decline? We have to go back to the COVID outbreak, when the markets were down as much as minus 32% and the whole world was panic selling their portfolios as Armageddon loomed. Subsequently, new vaccines were coming out. The market's decline stopped and took the opposite direction. The market formed a steep V. To kickstart the economy, massive amounts of money printing, quantitative easing, began around the world, and this was one of the causes of rising inflation. Subsequently, Putin's war in the Ukraine piled on top of this situation. The EU imposed sanctions on Russia, and the shortage of raw materials caused the price to rise. Commodities began to rise worldwide, and this marked a slowdown in the economy. This has also had an impact on the energy crisis, which has hit the European Union hardest, essentially dependent on imports of cheap Russian gas. The Chinese government's strict so-called zero-COVID policy contributed to a significant slowdown in the economy and caused a reduction in the consumption of oil and other imported raw materials. China turned inward and people protested en masse against the closure of entire regions. This difficult situation directly prompted Chinese President Xi Jinping to loosen the situation, and by the end of 2022 the region closures were reduced to city closures or narrower COVID areas. This mix of events, whether controllable or uncontrollable, affected economies on a global level and caused the rise in inflation we are dealing with to this day. By the way, I made a video about inflation, check out the link. What's going to happen this year and how to perceive the recession from an investor's perspective? The most important thing is to follow the actions of the Federal Reserve Board, Fed, which is in charge of the economic stability of the US economy. Especially important are the meetings headed by Jerome Powell, setting interest rates for the next period. This means how much people and companies will borrow and how much money will essentially cost. The overall path of 2023 will depend on how the Fed reads the inflation curve, which we see in the figure, and what the unemployment rate is, which we see in this figure from the same US Bureau of Labor Statistics website. These are the key factors that will affect the stock markets. It's essentially impossible to predict accurately whether the markets will take off now at the beginning of the year or not until the summer. Everything will depend on the further development of inflation and unemployment. There are basically two scenarios. Number one, the Fed will keep interest rates around 5%, meaning we should get rid of investments in banks as they will be shedding credit and writing them off against equity. The market will react negatively. The next sector is energy, oil, gas, electricity. If the economy remains in recession, energy prices will fall and there will be less consumption imbalances in production, means the US and Europe as exporters and Asia as importer will have big problems between supply and demand as the economy will be depressed. There will be a big fall in commodities, whether in industrial or consumer areas. Scenario number two. The Fed will cut interest rates because of falling inflation and stable unemployment. Markets will start to rise significantly to overshoot, and we will get inflation back to where we are now. Inflation will rise again and again, and the Fed will have to intervene. For this reason, I don't think the Fed will cut interest rates dramatically out of the blue at the beginning of the year. Rather, it looks like the Fed will continue to maintain its tightening policy. What should our portfolio look like? What should we invest in? In my opinion, this is an ideal time to select appropriate ETF funds that invest in broad baskets that replicate the indices, whether S&P 500 or Dow Jones Industrial Average, or for more hardened nature of the current significantly decimated Nasdaq 100. Individual stocks, unless you are really knowledgeable investor and are not in the markets every day, I would prefer to avoid in the current climate of uncertainty about the Fed's decision. I discussed a simple way to invest in the ETF SPY index in a recent video. You can find a link here. I think this is currently one of the best strategies for a long-term investor to put away excess cash in this way. For very low ETF fund fees in the tens of percent range, it's an ideal way to go. Together, it's a high value add for the investor and a minimal fee for the fund manager. So that's my guide to a safe way to get rich in the long run in 2023 and how to take advantage of the bear market to gradually buy in using the DCA dollar cost averaging method. Thanks so much for watching through to the end of the video. I look forward to seeing you next time. If you enjoyed today's preview of the markets, please give a like. Have a great day and invest wisely.